Good morning. We will pay attention to the effect of debtors' allowances on cost of sales when damaged goods are not returned. Any deduction on a debtor's account will always be recorded in the debtors' allowances journal, and when the accounts of debtors are reduced, you must determine if it will have an effect on cost of sales or not. The only exception on the rule is the debtor pays his account and discount is allowed because he pays promptly. This will be recorded in the cash receipts journal. Flour traders sold goods to P. Lowe for R3,000. The entity maintains a profit of 25% on sales price. That means the sales price equals 100%. Lowe notified flour traders that goods delivered to him were damaged during the delivery. He is prepared to keep the goods if the entity will allow a discount of 20%. The undertaking agreed to reduce his account with R200. They are not prepared to allow discount of 20% but R200. The entry will have no effect on cost of sales, because the cost of sales of the undertaking will not reduce because discount is allowed. The inventory does not increase because the goods were not returned. That means the profit of the business will decrease with the R200 that they allow. When the goods were sold, the debtors' control was debited with R3,000 to increase the assets. Sales was credited to increase income on the credit side with R3,000. Cost of sales increased expenses on the debit side with 2250, and inventory decreases assets on the credit side with 2250. When we allow the R200 discount, we have to credit the debtor's control account to show that he owes less money, and we will debit debtors' allowances to reduce the original sales to indicate that the income will reduce. The debtors' control is debited to increase assets. Sales is credited to increase profits and equity. Cost of sales is debited because expenses increase on the debit side, and that will decrease the profit, so the owner will get less profits. Inventory will decrease the assets on the credit side. When goods are sold on credit, we sell it to debtors, and it's recorded in the debtors' journal, and an invoice is issued to the debtors. When you allow the discount, debtors' allowances is debited to decrease the profit so that the equity will decrease. Debtors' control credited will decrease assets, and a credit note will be issued as agreement to reduce the account. This entry will be recorded in the debtors' allowances journal. When the account of a debtor decreases, the debtors' allowances is debited to reduce the income, and debtors' control is credited to decrease the asset. Determine if the debtors' allowances will have an effect on cost of sales. If it reduces the cost of sales, then inventory is debited to increase the value of inventory, and cost of sales is credited to reduce the expense. When goods are not returned, inventory will not increase because the goods are not coming back, and the cost of sales will not reduce because if the business allow discount to a debtor, it will not reduce the cost price that they paid.